Hi, and welcome to the latest episode of Mortgage Matters. I'm Andrew Overman of Location, and he's
Michael Webb from Mortgage Republic.
And every week we answer your viewers' questions, all related to the mortgage and finance world into estate agency. And this week we've got a great question, Michael. Remortgaging. What is it and how does it work?
Okay, so the term remortgaging is associated mainly with securing a new interest rate when your current deal on your mortgage is coming to an end. So if you have taken out a fixed rate or maybe a tracker rate, that is typically for a set period of time. That may be 2, 3, 5 years. At the end of that period of time, your 25-year mortgage would just continue on what's called the standard variable rate. Now, typically, that rate will be higher than what you have fixed your mortgage in at. So it could be that you fixed in at 2% and you will revert to a variable rate of 5%, for example. Now, if you do absolutely nothing, that will just naturally happen and your payment will change and you'll continue paying the higher interest rate and the higher payment. Therefore, people like to go for a process which has been termed remortgaging, which is a process of securing a new interest rate, be that a fixed or a tracker or variable rate, that is ideally better than the variable rate that they would revert to and gives them some form of stability, I guess, if they're going for a fixed rate, that they'll know what the payments will be for a set period of time. Now, the process to go through here is basically the same as applying for any mortgage. So you can do it up to, you can get mortgage offers for up to 6 months on a remortgage. So you can start looking at this, and you should start looking at this at about the 6-month point before your deal comes to an end. So if your deal's ending at the end of June, you want to start looking at it late December, although that's not the most ideal time, early January, to get a deal in place ready to go into force on the 1st of July. So you can do it very early and secure a deal very early. And that is very important in a market where rates are increasing, because you can then beat those increases with your security. You will apply for a mortgage as any other. So you will need the standard kind of documents of pay slips, bank statements, and you will need to obtain an agreement in principle and then proceed with your application from there. The mortgage broker that you're dealing with will run through your affordability, look at your outgoings, look at what's changed, talk to you about your priorities, what's important to you about this next mortgage deal. Is it flexibility? Is it security? Do you need to be able to port the mortgage because you intend to move in the near future? Are overpayments important? All of that conversation will happen, and then they'll have all the information to make a recommendation to you of the mortgage that you go ahead with. You will then go through the application procedure. There may be a physical valuation on the property, there may not, but there will be a valuation done on the property. However, we are seeing more and more of these done electronically and remotely for remortgages nowadays, particularly if you have a large amount of equity, so you're on a low loan to value. Once your mortgage offer is issued, you need to then have a solicitor in place to move the mortgage from lender A to your new lender B. Okay, they will do the conveyancing for lender B. They will, on the day that you want to complete, so in the example I gave, the 1st of July, draw the funds down from lender B and pay off lender A. And then they'll change everything on title and the charges and all of that. So when remortgaging, there can be that cost involved. However, there are plenty of deals that involve a free valuation and free legals. That's a very common combination for a remortgage deal. However, be aware it's priced in somewhere, probably within the interest rate. There's also deals with free valuation and cashback, and brokers, in some cases, I know we do, have access to systems where solicitors have signed up to say, look, if there's a cashback, we'll use the cashback and we'll provide free legals by having the cash back, pay the irrelevant value of the cash back, as long as it's £250 upwards. So as long as one of those apply, then you don't typically have a legal bill. However, if they don't, then you're likely to have a £600-700 remortgage legal bill, very approximately. The process to do a remortgage time-wise is, like I say, you can do it as early as possible. You don't want to leave it any later, ideally, than 3 months before the end, because you need to get time to get the mortgage offer and for the solicitors to do their work. Now, that's not to say that solicitors can't act very quickly when they're not busy. But if they are very busy, then they will work through things in the order they kind of come in. And what you don't want to suffer from is a procrastination penalty, which is you left it too late, the work can't be done in time, you've now reverted to the variable rate, and you have to pay that until you can complete. And maybe you pay 2, 3, 4, 5 weeks of a standard variable rate, which is much higher interest than you needed to.
Brilliant. That's great advice. And just to clarify then, so when you do a remortgage, your qualifying criteria are reassessed based on your affordability and your situation at that time?
That's correct. So if you want to move lender, you need to fit that lender's affordability, credit scoring criteria, and your property needs to fit the loan to value that you're applying for, and that will be assessed via evaluation. I'm sure we'll touch on it in another video, but there are options also to do what's called a product transfer, which is select a new deal with your new lender. Not all lenders do this, but the majority of high street lenders do. And you can then just select a new product and they'll give you a new fixed rate to stay with, I don't know, NatWest, for example.
Brilliant. And just to go a stage further, what happens if there's been a change in the property value when you're remortgaging? So let's say you bought 2 years ago with a 10% deposit, you've got a £180,000 mortgage on a £200,000 property that is now worth £250,000.
Well, that will be beneficial to you because your £180,000 mortgage is likely to now be, depending on the term you took it out on, let's say 175 owing, which means in your example, you've got £75,000 equity, which means you're at a point where your loan to value has reduced, and therefore you will get interest rates relevant to that loan to value. So let's say 75% instead of 90%. And in comparison, so we can't compare now against 2 years, but in comparison now and now, you can definitely say a 75% will be less than a 90%. The reason I make that distinction is you may be on, say, an 80% mortgage now, and you're remortgaging, but you took that 80% out, or let's say you took it out now, in 5 years' time, you might be at 60%, but still have to remortgage at a higher rate because that's what the market's done. But 90 through to 60, the lower the loan to value, the lower the interest rate will typically be.
Brilliant. As always, Michael, that's great advice. Viewers, thanks for watching this week's episode about remortgaging. Michael, if anybody wants to get in touch, how do they do so?
Probably best via our website, so mortgagerepublic.co.uk. There's our contact forms on there, and you can get in touch with us via the website.
Once again, thanks for your time, Michael.
Thank you.